Welcome to the deep dive. Today, we are plunging into the investing playbook of, well, a true legend, Warren Buffett.
Absolutely. I mean, the name itself is almost synonymous with investing success.
It really is. We're talking about guiding Berkshire Hathaway to just a mind-boggling 5,502,284% cumulative return. That's from 1965 through 2024.
Wow.
Yeah. And just to put that into perspective for you, the S&P 500, same period, right? A very respectable 39,054%. Big difference.
A huge difference. And the backdrop now is his impending retirement end of this year.
Exactly. So our mission today is to really unpack two of his biggest recent bets, these, billion-dollar bets, Amazon and Apple.
Two giants.
Right. We want to extract the most important sort of nuggets of knowledge from the sources, looking at why these companies are seen as such strong holdings. Companies that can potentially grow your savings, anchor a portfolio, even if you're just starting out with, say, $1,000.
And what's interesting is how they fit into Buffett's core philosophy. Berkshire's holdings are, they're just full of these competitively strong companies.
Mm-hmm. Right. That famous idea of the moat.
Exactly. The moats. These deep, wide advantages protecting the business. And even though they're tech companies, Amazon and Apple fit that mold surprisingly well.
How so? Because they seem quite different from, say, his traditional investments.
Well, at their core, they're dominant firms. Millions and millions of loyal customers deeply embedded in daily life. That loyalty, that market dominance, that is the moat Buffett looks for. It makes them excellent choices for long-term investors.
Okay, that makes sense. Let's dig into Amazon first. AMZN Berkshire took a stake back in 2019, which made some people scratch their heads a bit at the time.
Right. It wasn't a typical Buffett play, maybe.
But they've held on to it, maintained 10 million shares in the first quarter this year. That's a real vote of confidence.
It is, and it shows, I think, his ability to look deeper. Amazon isn't just e-commerce. It's a massive player in cloud computing, too.
Ah, AWS.
Exactly. The key insight is these multiple high-margin revenue streams. That's what makes it solid long-term, even if you mostly see the shopping side day to day.
And this is where, for me, it got really interesting looking at the sources. E-commerce, yes, it's the biggest revenue driver, 38% of their, $650 billion trailing revenue?
Huge number.
Huge. But Amazon Web Services, AWS, generates most of the company's $71 billion in trailing operating profit.
That distinction is absolutely crucial. It shows he's not just investing in the online store we all use. He's investing in that underlying high-margin infrastructure powerhouse.
The profit engine.
Precisely.
Yeah.
And AWS is seeing incredibly strong demand right now, especially for its AI services for businesses. AI is deeply integrated there.
And not just in AWS, right? The sources mentioned they use AI in the e-commerce side, too.
Oh, definitely. They leverage AI for things like forecasting product demand, figuring out where to put inventory to get it closest to customers.
Which leads to faster delivery for us.
Right. Happier customer.
And greater cost efficiencies for them, which hits the bottom line.
Exactly. It boosts the profit margins. It's a very smart, integrated system.
And it seems to be working. Amazon's operating income was up 20% year over year in Q1.
Yeah, and strong growth in other profitable areas, too, like advertising, third-party fulfillment services.
Yeah.
That all feeds into the bottom line. It potentially justifies, a higher share price.
So, okay, what does that mean for someone looking at Amazon now? Is this just good recent performance, or is there more to it for a long-term investor?
Well, you combine that growth with the stock's performance, it's returned, 66% over the last 5 years? Pretty solid.
Yeah.
And here's a really interesting point from the sources. Its price-to-earnings multiple, the PE ratio, is around 35. That's actually the lowest it's been in over 10 years.
Really? For Amazon?
Yeah. So for a company growing like Amazon, a historically low PE might suggest, it could suggest, the market is undervaluing its future earnings potential. The sources called it a compelling buy based on that.
Interesting valuation point. Okay, let's pivot to Apple, AAPL. Now, this one's a classic Buffett investment in a way. He first invested back in 2016.
And it's been one of Berkshire's absolute best investments
ever. Undeniably. It's still their largest holding, even after they trimmed the stake a bit last year.
Still massive.
But the stock's had a tougher time recently, hasn't it? Down about 20% year to date, I think. iPhone sales kind of flattening, weak demand in China mentioned as a factor.
That's true. The market's definitely focused on the iPhone slowdown.
Yeah.
But the key signal showing the underlying business is still incredibly strong. It's the services division.
Ah, right. Beyond the hardware.
Exactly. Services brought in $26 billion last quarter alone. That's 28% of total revenue, and it grew 12% year over year.
26 billion in a quarter from services. Wow.
Yeah, it shows a really robust, diversified stream beyond just selling phones or Macs. It's a different beast now.
It really is an evolution. And they're bringing AI into the devices too, aren't they? More personalization, iOS improvements.
That's the strategy. Remember last year's launch of Apple Intelligence? New AI features, writing tools, summaries, right on the device.
Right.
And the potential there is, well, it could drive device sales. If you need the new features, maybe you upgrade your phone or your iPad, especially as they invest in more powerful chips for on-device AI.
Creates that upgrade cycle incentive.
Could do, yeah.
And that ecosystem they have is it's enormous. Over 2.3 billion active devices out there. That's a massive advantage.
It's huge. And it feeds into their brand strength. Brand Finance ranked them the most valuable brand in the world. That loyalty, that ecosystem, it's hard to compete with.
And they're incredibly profitable, generated, what, $97 billion in net profit over the last 4 quarters?
$97 billion. That gives them enormous resources to keep investing, keep improving products, which ultimately should lead to more shareholder returns. Analysts are forecasting, I believe, around 10% annualized earnings growth long term.
So let's bring it back to the listener. What does this all mean for you? We've looked at Amazon, we've looked at Apple, despite, some recent bumps or challenges.
Yeah, market fluctuations happen.
They both seem like powerful examples of companies with those strong competitive advantages, those moats we talked about.
Definitely. And diverse revenue streams, too, especially high-margin ones like AWS for Amazon and Apple services. Plus, they're both betting big on AI.
Right. So understanding these elements, the moats, the revenue mix, the AI strategy, it seems crucial. Whether you're thinking about investing, maybe even just that first $1,000, or really just wanting to be informed about these giants shaping everything.
Exactly. They aren't just big names. They exemplify that kind of fundamental strength, that long-term strategic thinking that Buffett really values.
Okay, so as we wrap up, here's something to maybe mull over. A final thought for you. Both Amazon and Apple are investing heavily in AI, right? But in different ways. Amazon uses it for logistics, cloud. Apple integrates it deep into the device experience.
Very different applications, yeah.
So how might that shared focus on AI, but applied so differently, how might that reshape their own markets and maybe even how they compete against each other over the next, say, decade, even though their main businesses seem quite distinct today?
That's a great question. How does AI change the game when applied through such different lenses?
Something to think about. We'll leave you with that until our next deep dive.